So when it comes to investing, actual facts, they're not actually what it seems. And it can mislead you to the wrong path in your investing. And I just want to share with you some few points. The first one is median house price. So you can see in the news, the median house price went up, went down. So first, they are the locality. So when they are looking at the entire US, the market is too big. I think there are 400 metro areas, and every metro market behave by themselves. That's the first one. But let's take one metro area, and you can see the median house price went up. So what does it mean? So it can mean so many things. It means that maybe more expensive houses sold, right? So maybe there is more demand for the premium houses, and there is less demand for the affordable houses. That's maybe the median went up, but maybe not. Maybe there is a short supply. Maybe there is a short supply of the affordable houses, and there is a lot of supply of the expensive houses. So naturally, there are more sales of the more expensive houses. So that's why the price went up, the median price. So it's another misleading. Maybe the reason why the price went up because the most high demand product is like a 3-bed house, for example, three beds house. But there are not 3-bed houses in this market. There is only 4 beds. So the 4 beds, there's lots of supply. There is no shortage, but these houses are more expensive. So they are selling more. So again, let's assume you want to invest, you invest in this market. If you're going to find a 3-bed house, it's better than a 4-bed, but it's very hard to know because you can't see this information. You can't take split the market to 3-bed and 4-bed because most of the people don't do that. And that's a shame because if you want to be a good investor, you need to drill down to the actual facts and understand this market, 4-bed, it's not a good investment. 3-bed is a good because there is a shortage. If I'm going to able to get one in a good price, it's going to have a high demand, and also the price of it is going to go up. Okay? So that's about median prices. The next thing I want to talk about is when you see on the news, interest went up and what's the mortgage rate. And then you can see they're saying the mortgage rate now is 6.72. And when you are going to apply for a loan, you are getting 7.5 or 8. So why is that, right? So again, this number is only for 30 years, fixed 30 years. And if you have a credit scores of, 700 and above. So again, they don't share everything. If your credit score is lower, or maybe if you have some more exposure to other loans, or maybe some of them are riskier, or maybe it's going to be an investment for you, it's not going to be unoccupied, your rate going to be different. So those rates are very misleading because you can say, hey, but I saw in the news, the current interest rate is like that, but so why do you give me a quote for this amount? Again, with unemployment, the same thing. So you can see on the news, the employment rate went up, down, it's 3.5, 3.7. But if you go down the numbers, you need to understand what kind of jobs, what kind of job opportunities are in supply or in a high demand, right? So maybe it's the low-paying jobs. They have lots of low-paying jobs, but there is a shortage of high-paying job. So what's going to happen there? So again, think about the locality, not just think about the whole US. So again, if there is a shortage in the high-paying job, so there is going to be an affordability issue, right? So you cannot focus on the high end of the market if you are talking about rentals. So again, because there are so many facts and you are bombarded by so many informations about houses, about the economy, about the politics and everything, and I think it's very, very hard to make a decision. That's why I like private lending, because all this information is irrelevant because you are creating your own. It's like a blue ocean, in my opinion. If you read this book, it's a blue ocean because you are creating, there is a small world that you are in control. So there is you and the borrower and this property. And you are lending money for someone that needs some loan, but they can't get this loan from another source, like a lender or bank. And once you understand that the property value is a lot more than what you're gonna lend for, you are safe. You just make sure that this borrower is able to pay you over time, just to understand what they are looking to do with this property. And that's it. So it doesn't matter if the market goes up or down. Doesn't matter if the interest rate goes up or down. Doesn't matter if the employment is going up or down. You're going to be safe. Because even the worst case, when this borrower or this homeowner or this investor not going to be able to pay you back, you're just going to get the property. And again, my rule of thumb is you don't lend more than 65% of the property value. So even in the worst case, the property went down by 10, 15%, which is a lot, okay? Your funds still going to be protected. If you want to keep learning about private lending and how it's maybe a nice vehicle for you to get cash flow, maybe it's going to be a nice vehicle for you to grow your funds, click on the link below, a passive retirement account, and I'm going to see you there or the next video. Bye-bye.